Thanks for tuning in to the Talking Point podcast. The topic that we have chosen today, on my back, the energy transition gigatrend. And a lot of you know that energy transition is a large sector and a large opportunity. I have had the fortune of reading one of the most well-written and well-documented pieces of work on this subject by Team ValueQuest, and therefore I thought it was just important to get them on this podcast to try and understand how do they think about this particular topic, what has gone behind that months and quarters of work that they have put in, and what are the investing implications of this gigatrend. Gentlemen, all of you, thank you so much for joining in. Varun, Goenka, Ravi, Dharamshi, Dr. Arvind, Ananthanarayanan. I hope I've gotten all the names correct. Thank you so much for joining in. And Ravi, of course, you need no introduction. It's a pleasure to have you back on this show.
My pleasure to be here.
Yep, and great to have both of you as well along with.
Thank you, Niraj. It's a pleasure to be here as well.
Thank you so much. So just before we get to energy transition, can we just start off by how you have aptly described in your amazing piece of work, that book, Gigatrend. Why do you call this a gigatrend?
No, so first of all, it's a play on words, but giga is essentially associated with electricity, megawatt, gigawatt. So that's the reason. And also to highlight the fact on the enormity of that trend. Essentially, people tend to underestimate the kind of change that is happening. In my opinion, this is the biggest change that humanity is seeing since industrialization. Okay, during industrialization, we built this large capacities of manufacturing, and we learned how to manufacture things that, mass produce and build at scale. This is the most important change happening to that industrialization since then. And the best part about it is it's not like energy transition is new. We have moved from sources of energy all along the last human history. But this is the energy transition which is happening with a timeline and might have the highest order of change. So renewables as a percentage of the electricity generation probably was less than 1%, 5 years back. And it will end up probably closer to 70% in the next 30, 40 years. Now, that kind of a dramatic change is definitely going to lead to a lot of value migration from one sector to another. So that is what we wanted to highlight, and that is where the term gigatrend came in. Today we talk freely about energy transition, but when we first started looking at it, there were other names like decarbonization, clean tech. Around 2019, when COP27 came in, and 190 countries or 90% of the GDP of the world agreed to a net zero target. That was the time. We had been looking at it prior to that, but honestly speaking, there were no investment opportunities in India. Biofuel was one of the first one to pick up, but that's a very small percentage and very probably restricted to few countries like India, Brazil, maybe some other Southeast Asian nations. So from that perspective, we used to call it decarbonization, clean tech, that kind of an industry. But honestly, at the core of it, what this is the transition of fossil fuel sources to renewable sources. And this is a huge change, and it is going to, impact a lot of things. It will create new leaders. It will give birth to new industries, and it is going to create tremendous wealth. So that is the reason why we called it gigatrend. And I'll let Varun, who's put together the book, add a few points to it.
So thank you, ValueQuest, because of this platform, the kind of work we have done in the last 3 years, the whole team put together. I'll give you some why this name came and some nuances of it. In simple words, one, it is a multi-decade, multi-technology, multi-terawatt, and multi-trillion dollar in terms of the trend. And that's why we keep hearing the word mega trend, but this is several times bigger than mega. This is usually, for example, we had the IT boom, we had the pharma boom. They're usually in the range of 10 to 15 years odd, where there is a spurt of industry growth. But I think in case of this energy boom, and while we colloquially keep using energy transition, this is not just an energy transition story. Transition means you are just switching from a certain energy source to a new energy source. This goes way beyond it, where countries are even becoming energy independent. You were importing your energy, and now you want to become independent. You want to generate in-house, right? And the third being affordability, which we'll cover, that this is probably solar, for example, which is going to be the dominant source, is going to be the cheapest form of energy, cleanest form of energy, most scalable form of energy that we could have ever invented.
Wow. Okay. Arvind, you want to add to this? By the way, Varun just conveniently trashed the topic that we've given. We're calling it the energy transition gigatrend. You trashed it, but that's okay. Completely
What
fine.
he's saying is even energy transition is not big enough to capture the entire trend.
Yeah. It showed in the way he was talking about it. Arvind, yeah.
I mean, thank you once again for sharing our views here. In continuation with what my other colleagues have just mentioned, I would have to say that the energy transition stands at a unique point in human history. This is the first time that we are at a confluence of materials science, information technology, and financial power coming behind this sector. There is investments coming into this sector, and they're not backing something just for the sake of the planet Earth. There are hard economic reasons to do it. Now, coming back to the point of what Varun again mentioned about energy independence, renewable energies democratize energy in the true sense of the word. There are no countries which hold the reins of energy and can extract higher than expected economic rents, causing super cycles. This is truly a flattening of the global power curves.
Please finish your point, sorry.
Yes. And this is an opportunity which, since we call it a transition, it should actually be a revolution. But then I suppose everyone thought it was the French transition till it became the revolution after a point. So that's how it is. Fundamental relationship with energy, how we generate it, how we store it, how we transport it, how we use it. It's all going to change, and it's just beginning.
Okay, so the naysayers might argue, Arvind, that when we took off battery storage, lithium batteries are the dominant forces, and there is one nation which arguably has a stranglehold on lithium reserves largely. So there might be sporadic instances of maybe one nation or one set of people having a hold on things, but by and large, if you look at the whole ecosystem, you're saying it's very democratized.
Yes, that is what I'm trying to say. And another point that I would like to bring up here is that unlike oil, where if I don't want to extract it, I can just leave it in the ground. I have no cost of not extracting it. Whereas if I've decided that I want to dominate the world by creating refining capacities for lithium and battery assembly facilities, if I don't get to use them, depreciation is a real cost over there. So that is another point. So these are industrial facilities. They have to be used. They will get obsolete. New technologies will replace them. Stranded capacities are a reality of industrialization. So all of these serve as counterweights against the avaricious hoarding of natural resources.
Okay.
I would just like to add to that point that this is not a single technology focused trend.
Right.
It is, and what Arvind keeps telling us all the time is this is a hands-on deck approach. Whatever technology is applicable wherever, whatever works best is going to happen. It's horses for courses, he keeps telling us. And maybe you can expand a little bit more on that. But essentially, lithium ion is but a single slice or a single piece in this entire thing. And there are, as Varun mentioned, it's multi-technology. And there are many things that are going to happen beyond lithium ion as well. But yeah.
And Arvind brings with him some real decades or real, how do I say, caps of wisdom, Ravi. I mean, I made a mistake of not introducing his accolades earlier, but PhD in physics, 2010 by University of Mumbai, some tremendous work experience. I heard you speak volumes about what he brings to the table as well for Team ValueQuest too.
He has 11 patents to his names.
Amazing.
To his
Okay.
name.
Okay, you want to expand on that?
Yes, I'm flattered and thank you for that. Other than this, I would say that when it comes to this all hands on deck approach, it starts with one fundamental difference of renewable energies versus fossil fuels. Fossil fuels, by their very nature, are highly energy dense. Imagine that you're wanting to collect a cup of water and you're standing under the Niagara Falls. If a lot of it spills over and goes wherever it wants to, I don't care, my cup's getting filled. Renewables, on the other hand, are not that energy dense. Even the fill factors for solar are to the tune of around 25%. That's the efficiency of the panels. So you are very conscious of how you're harvesting the energy and using it. That's the first thing. Secondly, you would not want to put up solar panels. Like, for example, if I want a thermal power plant, I could put it up in the coldest of geographies. I could put it up wherever I want. I can't do that with solar. I have to make sure that the sun is available.
Yeah.
This has been one of the bugbears of the wind sector. How do I size my turbine and hub height properly for a particular for a geography and the wind? And then will climate change make the winds change that these turbines will then get stranded again? So again, it's horses for courses. For batteries particularly. Now, automobile fuels, if we think about it in that sense of the word, they are at once energy dense and power dense. I can just take a lot of fuel, burn it all very rapidly and get a lot of energy in a short time, which is the definition of lot of power. Alternatively, I could burn it very slowly and extract a lot of energy over a slow period of time with the same pile of fuel. I can't do that with lithium ion or any battery chemistry. I have to take a hard choice. Do I want a battery that will give me steady energy drain out for 10-hour periods? Or do I want a battery which will give me a lot of energy very rapidly? And the final problem is with a battery, if I have a lot of energy stored in something which is released instantaneously, it's not an energy storage device, that's a bomb. So then the battery management system plays an important role. So various other technologies will come together and we'll choose chemistries. NCM, if I want a car, LFP, if I want storage, or commercial vehicle applications, maybe other battery chemistries. So that's what it means. We are moving down multi-channels to ultimately address decarbonization and all the aspects of the energy transition, so as to speak.
Okay,
Niraj, I'll offer you a quote, what Dr. Arvind is trying to explain. An analysis of the history of technology shows that technological change is exponential, not linear, contrary to the common sense of intuitive linear. So we won't experience 100 years of progress in 21st century or the next. It will be more like 10,000 years of progress in a very short period. The returns such as the chip speed, right, or silicon technology, and cost effectiveness also increase exponentially. There's even an exponential growth to this exponential growth. This entire solar value chain is built on the silicon semiconductor technology. And the same things that are happening to our mobile or computers is the same learning rate, the same technological speed that is in solar, because the building blocks are the same.
Got it. What you're effectively trying to say is that the rate of change will be unprecedented and will be very, very quick or very, very fast over the course of the next, let's say, 80 years or 76 years, give or take.
And human mind is never able to comprehend exponential curves. And Ravi, in his earlier presentation, has shown the analogy of horses to cars. It took 13 years, merely 13 years, for that transition to happen, where thousands of years of mobility changed when the technology inflection happened. In case of automobile, there were tires and combustion engine, etc., manufacturing assembly line and all that.
Yeah, I saw that picture. It was interesting. 2000, there was one car and all horse
1900,
carriages.
yes.
Sorry, 1900, yeah. And then 1913, if I'm
13,
not
correct.
wrong, yeah?
Yes.
Just one horse carriage. Yeah? Interesting
so
picture.
basically, human mind tends to look for faster horses when you talk about technological change, but that's not possible. Obviously, with the combination of the fact that rubber technology came in combustion engine came in, metallurgy came in, gave rise to an application of car, which was not imaginable prior to that. And that is essentially what caused that disruption. And this is just one example. There are scores of such examples where when confluence of few technologies suddenly lead to a dramatic change. Right in 2008, when Apple was launched, the first Apple was launched, the guys like Nokia actually totally ignored it,
Right.
but they didn't understand the fact that what smartphone was. They were stuck in that old mobile phone, and which itself was not a very old technology. That was barely a 10-year-old
Yeah.
technology, and suddenly it got disrupted in the subsequent round.
Okay. So one of the things that you guys have said, and I'm trying to now correlate this to investing because that's what everybody will be out here to listen to, in addition to the, of course, the learning that all of us will get on this whole technology piece as well. And I love that line you've mentioned. I mean, you quoted somebody saying that the opportunity of a lifetime, which this seems to be, must be seized in the lifetime of the opportunity. Is this lifetime of the opportunity here and now, Ravi? Are we early, or is this the right time? And will this be lasting for multi-decades?
Oh no, I think if I were to give you a baseball analogy, we are in probably the first inning. So I have no doubt there's a long way to go. But having said that, I think I'll just explain to you a framework that we have on how we keep tracking these mega trends. And I mean, you could have bet on flying cars 40 years back, 50 years back when Back to the Future came in, but they never materialized, right? So it is very important to track the building blocks of that technology, and when they reach that inflection point is when suddenly the mass adoption happens. So we have a framework that has been propagated by Arvind. When technological certainty is achieved, when unit economics fall in place, and when the scalability and the business models are aligned, is when that mass adoption of a technology tends to happen. And that is when we should be looking at investing in it. We are, for all practical purposes, we have been public market investors. Now we do some private equity in the late stage, growth stage, but we are not venture capital investors. We are not going to bet on a new visionary technology which is in the realm of possibilities, which may or may not become a reality 20 years down the line. We tend to invest in business models which are right here, right now, and will generate economic profits in a 5-7 year time horizon. That is what we are looking for. And from that prism, we wait for the technology to achieve all those parameters. They should satisfy all those parameters before we even start investing in it.
Okay.
And I'll let Arvind add a few points to that.
Indeed. Alexander Pope had said that in Words' fashion, the same rules hold, alike fantastic if too new or old. Be not the first on whom the new are tried, but don't be the last to cast the old aside. So to flesh out Ravi's framework, or what he just said, if we look at a 3 to 5 year horizon, it can be seen with a lens of also financial discipline. We can assign probabilities to certain outcomes, which then allows us to invest with a more clear lens. Looking further out, the funnel of possibilities becomes a virtual cornucopia of possibilities. Everything is possible 10 years down the road.
Right.
And at the same time, there can be many competing technologies which are still vying for a place. Let me give an example. If we look at the battery storage scientific literature of 3 to 5 years ago, when lithium ion was still not as developed as it is, and battery costs were about $175 odd per kilowatt hour kind of energy. Zinc batteries, redox storage batteries, these were all the rage. But then as lithium ion batteries have now suddenly become more capable, less volatile and less flammable, for example, these other chemistries are being pushed or edged out of the equation. This is why we should not look too far out into the future. The future is truly uncertain. So we like to keep this 3 to 5 year horizon where all the blocks, all the ducks are in a row in terms of scalability, in terms of the technological maturity. And by this time, certain size related moats would have built up around the technology. So it would not be easy for some new venture capitalist to just come in and push the house down. Nevertheless, in passing, I would say that we are also careful about one clear adage. Every revolution finally consumes the revolutionary. So we are looking out to new trends which might allow that to happen.
Okay.
Niraj, I'll offer you a case study which is there in our book, which will exactly put the facts on it. So this is the year is 1976. We have installed 1 megawatt of solar panel in the entire year. And the cost of that was $100 per watt. Today, solar panels are globally traded at a per watt. That $100 per watt price today at the end of CY23 is 15 cents per watt. So that's a 99.9985%. 99.9985%. I'm giving you the fourth decimal. So in the year when 1 megawatt was installed, the value becomes $10 million. Fast forward 37 odd years, this year, CY23, we installed 380 gigawatt. If you multiply it by 1,000, you get megawatt. So 380,000 megawatt. And the value is 15 cents. So that comes to $57 billion, which translates into 5,500 times. Despite a 99.9985% decline, the industry revenue has gone up by close to 6,000 times. And that is what Ravi was alluding to, that we tend to underestimate or focus just on one variable, which is price decline. But the kind of rate of adoption it leads to, and that is seen in mobile technology or anything, anything.
Yeah, sure.
Right.
No, but this is amazing to know. Okay, so Varun, my question to you is, and I want to now nail it down to what some of these individual technologies could be like, and what are the investing opportunities out there for people as well, right? And how do you look at it from your lens? But there's a part in the book which speaks about how the multiplier for each of these, energy storage, electrified storage, hydrogen, nuclear, carbon capture and storage, and what is the multiplier factor out there? And when I look at that number, I'd love to explain this, because when we show when they show that grid on the screen, a lot of people might not completely understand it. So on carbon capture and storage, the multiplier is 45.9 times, nuclear 8.7 times, energy storage 2.6 times. What does this mean?
So actually, the book is just the tip of the iceberg, compared to the work that the team has done. These are basically the value increase in terms of industry. So today, I'll give you one stat, what we have calculated. So there is approximately a $400 billion capex that is going to happen in India from now to the next 8 to 10 years, right? Approximately, correct me if I'm wrong, Ravi. I mean, India is a relatively lower spend compared to the developed world.
Sure.
So there is almost like a 6 to 10 times increase in the cumulative value that is standing today. So like solar is 90 gigawatt and is likely to come 500 to 600 gigawatts. So that's a 6 to 8 times from here. So that's what we had tried to map, that what is the size increase either in terms of value or capacity.
But is that the investable opportunity? I mean, if the multiplier factor on nuclear is so high, 8.7 versus maybe energy storage at 2.6, is nuclear therefore the place to be in, or is nuclear not the place to be in? How does one identify? How do you identify?
Nuclear scientists answer that.
Former. But anyway, let's break it down. It's not just the growth in the industry that should matter.
Okay.
Of course, that matters. But at the same time, one should also look at the quality and the predictability of the growth. For instance, we prefer to be in sectors where the predictability is relatively high.
Okay.
In the sense that even if the absolute multiplier may be relatively lower, if it's 100, a multiplier of 2 will still take it to 200, versus if it's 10 and the multiplier is 8, it would still go only to 80.
Right.
That is one point. The second thing is, whatever be the sector, we prefer technologies which have excellent scalability. What I mean by this is, if we take solar, I could have one module, I could have a multi-gigawatt solar farm, essentially, generation farm. They will all be built of the same building blocks. This is where the first of a kind versus nth of a kind paradigm comes out. So even though so it's not just the multiplier, we are also interested in how quickly the technology will mass produce, which is where the learning rate comes in. If I may mention it very briefly.
Please do.
It is how much the cost reduces for a doubling of production. If production keeps doubling very rapidly, then even though on each doubling your cost reduction may not be massive, if the doubling time itself is compressed down, the overall cost reduction would be that 99.9985, which Varun was talking about. Now, coming back to nuclear, there are significant points. Now, across the literature, there are a wide range of numbers about this in terms of levelized cost. Lowest estimates can be as low as $77 per megawatt hour. Highest estimates, Lazard others have estimated, some say as high as $350 per megawatt hour. But in nuclear, there are certain other costs. First, there are costs associated with mining the uranium. The second most important cost with nuclear is the decommissioning of these facilities. And thirdly, nuclear, even though it could have a 99-year excellent record, the overall cost of the cleanup around Fukushima Daiichi has still not been properly estimated. So there are fat tail risk events.
Okay.
And finally, the time required to build a nuclear facility is the biggest elephant in the room. Even though it is a form of energy which has some major advantages, it is very high energy density, round the clock, uses very little land. But if you're taking 18 years to build it, it's 15 years to build it, that's a problem. And when we say that many nuclear reactors are going to be installed, they're still in multiples of 10, not in multiples of 100. So each reactor has to be optimized for its particular geography. Now, some countries like France have gone around this and they certify families of reactors, the way, for example, the A320 is a family of aircraft certified. But that still doesn't change the fact that you have to geosensitize, or you have to do great studies to see where you're locating the reactor. Each one is virtually first of a kind. And then you need a lot of highly educated, highly trained personnel to run these facilities.
So there are issues.
So there are substantial issues. So nuclear may have a role to play. However, we firmly believe that the decade belongs to solar energy, and battery storage will simply revolutionize that.
I just want to simplify a little bit what Arvind just said. The mass adoption of any technology rests on three legs. Affordability, acceptability, and availability. Nuclear falls flat on two of those legs, affordability and acceptability. Both of them are not there yet. There is something called as NIMBY effect, not in my backyard. Not many people are going to agree to having a nuclear plant in their backyard. That is why we remain skeptical about nuclear mass adoption. I mean, it might happen, who knows, 50 years from now, but in the next 10-year horizon, it doesn't look likely.
Got it. In fact, and which is why I think one of the things in your book mentions this, that studies find that the simpler and standardized technologies are more likely to scale, and that seems to be solar PV modules and LEDs as per the book.
Yes, which again plays into the learning rate curves, because you can mass manufacture the modules in facilities which are highly automated without skilled engineering teams and skilled personnel of that highly technical level, like a nuclear reactor, for example.
One very interesting thing in the book was that you guys have mentioned that the renewable energy sites are poised to become the most valuable real estate, outpacing digital spaces. I didn't get a gist of this. Can you please explain?
So in the first few pages, we tried to bring in some analogies of how big this thing is. So which is together the biggest real estate? Yeah, it is our mobile phone actually. You know, that's where our eyeballs are. Now, I'll just build upon what Ravi and Dr. Arvind said. See, solar, you imagine there is the giga-scale solar parks in Rajasthan, Gujarat, right? there is a captive power plant of any corporate. There is rooftop solar, okay? There is green hydrogen that will require solar. There is a battery plant that will require solar. The applications, by the way, there are several technologies in solar which are flexible solar. You can wrap it around a windmill, you can wrap it around a dome, you can put it on a warehouse. Rooftop solar has multitude applications. So now, you were asking us about?
The digital space, most valuable real
right.
estate. I was just intrigued by that comment.
Right. So today, the basic thumb rule is every 25 megawatt of solar requires 100 acres. In Gujarat, today, 50 gigawatt, which is almost close to like 5,000 square kilometers of solar parks are under development. So we're going to see large scale, gigawatt development in deserts. We're going to see captive power plants with corporates. We're going to see rooftop solar right now dominated in Rajasthan and Gujarat, but other states are already adopting it. We're going to see small scale solar, so all around us, we just have to notice how solar is going to spring up in every building, in every rooftop, in every car parking, in every retail joint, obviously captive power plants, to corporates. Let me also add another point. This is probably the only trend where no institution is coming in the way. So there are sovereign governments, there are private equity investors, there are pension funds, there are corporates, there are retail. You can imagine, and everybody's investing towards having a piece of it. Versus a nuclear, a government has to do it only. Or a wind, only a few places would support.
Okay, so Ravi, let me now try and drill it down to how can an investor look at it, and I would love to know how you look at it from an investor lens. So there's a page 67 in your book which had some various schemes written down. Which according to you is the most powerful and investable energy transition, for lack of a better word, energy transition theme available out there? Is it solar? Is it solar plus other things? And not everything has to run at the same pace, but they could all be great investment opportunities.
Yeah, so let me first lay out for you how we map this theme. So a theme can last 20, 30, 40 years, but we don't invest necessarily directly in the theme. We have to still further drill it down to a sector or a subsector. And as we mentioned earlier, in a time horizon of 5 years, we don't want to be investing in sectors which might make money 10 years down the line. So from that perspective, what is changing? The way the power is generated is changing. The source of energy is changing. The way the power is transmitted and distributed is changing. And there is going to be an electrification of everything. And then there are new technologies on the horizon which will enable a lot of things like battery storage system, hydrogen, ammonia. So in the sources of power, or the way power is generated, there is biofuel, nuclear, solar, wind. In the power transmission and distribution, which we believe is here and now opportunity and has the maximum delta from the next 5 to 10 years perspective, there are power cable companies, conductors, transformers, and downstream value chain of the same. And on the electrification side, of course, there are e-buses, e-two-wheelers, three-wheelers, commercial vehicles, and many other applications. Now, this is how we map out the entire opportunity of energy transition. Then we apply it to our framework to see where is the technological certainty achieved, where the changes are going to be incremental from this point on, and not necessarily dramatically. For example, solar PV modules are at 25% efficiency, as Arvind mentioned. Will it go to 30%? Probably, but it will take probably 10 years before it reaches 30%. So it's all going to be incremental changes. And it is not going to be, capturing of the sunlight that is going to change. What is going to change is probably you need to have bifacial, like have panels on both the side, or you're going to have technology which makes you orient towards the sun.
Trackers.
So all those things are incremental in nature. So the technological certainty has been achieved, and we might move from, let's say, currently we were at monoperc, we are now moving towards TOPCon, and we might have HJT or peroxide.
Sorry, what are these?
These are the new technologies in solar, but these are not dramatic technological changes that are going to happen. These are, you can see them coming probably in a 3, 5, 7-year time horizon, and you get the opportunity to sweat your current assets even if the new technology comes. So for example, we might have moved to TOPCon, but some of our earlier technology, which was the initial technology, crystalline, monocrystalline,
actually,
is still, it finds applications somewhere or the other where cost is more of an issue and not necessarily the efficiency of the panel. So it is not necessarily that your previous technology goes to zero. You can refurbish those plants for new technology, and you get time to adapt to the new technology. So we are looking for that technological certainty. Second thing that we look for is, of course, there has to be a economic value add. It cannot be that, for example, today, a lot of people see one aspect of in solar value chain, which Varun said, that the prices have fallen. Yes, prices have fallen, but that has led to dramatic scale up in the deployment. Also, people say, Chinese companies are making losses. I'm actually happy about it. If Chinese companies are making losses, that means that they are selling below the cost of production. If they are selling below the cost of production, means there is a floor somewhere below which the prices will not fall for the moment. They have fallen 99.85%, and over a period of time, there will be further efficiency improvement and everything. But at some point of time, that unit economics will kick in. But what is the most important piece is, which people don't appreciate, is this. Yes, on hard economics, also this technology can stand on its own, but there are considerations beyond that. Geopolitical reality and energy security is a far higher consideration for a government to ensure that a local supply chain is developed. And what Arvind mentioned earlier, that we had to pay economic rent because oil was found under the desert of Middle East, and it was not found in our geography. That puts us at a disadvantage. We don't want to repeat that again in the new age of renewables, where we are at the mercy of our rivals who will be supplying the technology for generating this energy. We have to develop our own supply chain. It is far more strategic. And people talk about, how we are increasing the cost of deployment of solar technology in India by putting in the basic customs duty or bringing in ALMM. That would be really, really short-sighted thought process if we were to, let the Chinese flood in over here, because we will never ever develop our own value chain, our supply chain, and we need to do that because energy security and energy independence is far more important than a few $1 billion extra that it is costing us today.
Okay, so from an investing perspective, solar certainly fits the bill.
Solar is one thing. Second is power transmission that I mentioned.
And within solar, sorry, just to round off this point, within solar, is it the solar power generating companies as a pick and shell strategy, right? So how is it that you guys are thinking about it? Because it's a large theme that you have established. Now, how to play this theme within India?
See, solar developer is also making fantastic IRRs. Okay, the good part about solar is there is very little variability once the asset is put on the ground. It's not like we will not get coal from Indonesia, or we had put in a certain price point and that price point is not manageable now. In fact, for all practical purposes, prices are further falling. So the IRR for a developer is actually increasing if they were to put up new capacities now. So from that perspective, it is good. But we are equity investors. We are not, we are never satisfied by a 12%, 13% project IRR, and with a little bit of leverage, maybe 17, 18% IRR at, equity IRR. those are great returns for somebody, a large development institution that is looking to deploy large capital, absolutely fantastic quasi-equity return kind of like returns. But for us, we look for dramatic scale change. We look for not every investment necessarily, but we do look for some places where we can hit it out of the park. So from that perspective, developers are not so much of our core competence. We look for picks and shovels sellers. So the analogy that we like to give is in the late 1800s, was it? When was the gold rush in California?
Yes.
Not many people found gold. Few people did find gold, but anybody who was selling shovel over there or even a lemonade stand, that guy made money.
Right.
So we like to focus on the probability rather than only the potential.
Got it.
It's the combination of potential and probability that gives us that confidence to, okay, now this is the place to be betting on. And people tend to, in this evolutionary phase, honestly, a lot of people feel this is commoditized business. The opportunity is for X years. What will happen after there is oversupply? People don't understand that the cash flows generated in that period. First of all, you cannot say if this opportunity is ending in 3 years, 5 years, or it might continue for 10 years.
Yeah.
Second, you don't know the size of the cash flows that will be generated in that time period. And that cash generated during that period has its own option value. Companies evolve. Me taking a little bit more investment thought. When Rakesh ji invested in Titan, he didn't think for a moment that he's investing in a jeweler. He was investing in a watch company. But look at where the value was created eventually.
Sure.
The cash flows of watches were used to seed the
Jewelry business.
And that's what created wealth. So similarly over here, companies might start off with modules which might seem like low value or assembly operations, but you backward integrate and further backward integrate and then use that cash flows to build adjacencies in the other parts of the energy value transition chain.
And Indian companies are doing that.
100%. The thought process is there for everybody, but it is not going to happen overnight. It will take time. So that is why it is important that that window of opportunity is given to the Indian players so that they can start competing with the Chinese and so that they can build these adjacencies around it. And a lot of people say China dominates 95% of the value chain. Varun made an excellent point earlier in our discussion that if China had a 50% market share, they would have fought tooth and nail and tried to gain market share. From 95%, where do you go? The only way is to go down. And the world can see it, that we are totally beholden to what China is going to give us at whatever price they want to give us or however they want to do it. Right now, the recent price fall is a way of essentially stopping the proliferation of the value chain in other parts of the world, which is what America and US is trying to protect against. You need to provide that window of opportunity so that we can fight against the total dominance of China in this sector.
So then who wins? I mean, in India, so therefore a power producer may also do well, but that's the 13, 15, 17% IRR which you are not interested in. So you are interested in picks and shovels. So are there large opportunities? I'm not asking you to name stocks, but what are the nature of these companies?
No, so I think the biggest piece, no doubt, is the solar panel, because the sheer volume, we are going to go from, till last year we were doing 15 gigawatt of annual, and we are probably going to reach a annual installation of between 70 and 100 gigawatt per annum kind of a run rate. Just to give you a perspective, way back in 2014, the Chinese companies were 1-2 gigawatt in size. Today they are 150 gigawatt. And mind you, this scale up has happened when only China was investing. Now, Europe is investing, US is investing, Latin America is investing, Africa is investing, Southeast Asia is investing. So now we are going to see a scale up of rest of the non-Chinese supply chain in an era where the whole world is investing in this. So no doubt about it, this is the most scalable part of the business, but it will be the most competitive also. And it will be capital and technologically intensive also. So not an easy game to win at. But there will be smaller niche around this where you will find. So for example, whether it's a solar tracking company, whether it's some mounted structures kind of a company, or solar EPC company, rooftop solar company, finance companies, there are many parts of the value chain which will also make money, and that profit pool might not grow to become as big as the panel, but it might stay protected for a longer period.
Interesting.
Niraj, I'll give you some interesting data around here. See, I think as a team, like you started with, we look for data, evidence, primary and secondary research where there is none, right? In this renewable space, there was no research, we did it. So our calculation is in the next 3 to 5 years, the operating profit of this entire renewable value chain in India is going to be close to 2 lakh crores.
Not just solar, everything put together.
No, solar. I'm talking
Solar,
about the whole
okay.
renewables, solar reactor.
Solar, right.
Not hydro, not nuclear, right? Now, what is this 2 lakh crores? Today, pharmaceutical industry EBITDA is 1 lakh crore. Entire auto component industry is 1 lakh crore. Now, both these industries are all 30, 40, 50 years old. Now, coming to the value chain, so if you break down the solar value chain, the building block is sand to polysilicon, where you require mega capex, 25,000 crores for a single plant. You need very cheap power. Both of these, India is far away, probably 10 years away or something, you know. Maybe some conglomerates will start that in the next 2-3 years. But again, capex will finish maybe 5-7 years later. Second is wafer, ingot, wafer, cell, and module. Right now we are hearing module, and that's going to be very big for India. India will probably become like 10% market share of the world. And it's a very big opportunity for India to supply wherever people are looking for ex-China. If somebody's okay with sourcing from China, there is no way India can compete. But otherwise, you know, countries like US are looking to have another alternate source. India is already doing backward integration, like Ravi said, towards cell, and wafer is the inevitable in the next 3 to 5 years. That is the first level. The second degree is going to be even bigger or as big. Cable, you know, the whole power cables. Now, power cables are going to be needed to connect one module to the other, connect the farm to the substation, connect the substation to the grid, and within grid, when it lands to the local transformer, again, connect the transformer to your homes, or even EVs, you know, rooftop solar to your house, you need power cables. To connect your home to the EV charging station, you need power cables. Power cables, again, is a very big opportunity. Then high voltage transmission cables, mounting structures, glasses, EVA, backsheet, you can name it. We are talking about an industry where the first order, second order benefit is going to create an industry the size of 2 large industries in India in the next 3 to 5 years.
Quite stunning. Okay. So that's one. Now, I'm moving on. So you kind of got some inkling about solar, but there are a lot of others. I want to go to that. And I would love to get Arvind in on this conversation on the battery value chain.
Okay.
We spoke about it before we started this podcast as
Correct.
well. You seem enthused by it. Was I mistaken?
No, you're not mistaken. You were extremely correct about that. One thing that has been holding back renewables for a long period of time has been the variability. And by variability, it is not just about the fact that, oh, it's not available at night, it's available in the morning. There is also a significant mismatch between the peak demand, which is usually late at night when people go home, switch on their appliances, versus the peak generation of solar, which is around the middle of the day. So storage is an excellent way to ameliorate this problem. That's one use of batteries. And if we look at emissions as a whole, now we've been speaking about energy without actually addressing the elephant in the room, which was the emissions, which is the problem. One of the largest emitting sectors after energy generation is transportation. So EVs also come in over there. Now, both these applications require a form of energy storage, which is, of course, the batteries. So in the battery value chain, if we see, we have seen exponential cost decreases over there as well. At the beginning of the 1990s, it was about $1,000 per kilowatt hour. Presently, we are tracking to sub $100 per kilowatt hour for NCM chemistries. LFP is already at 50 to 70. And LFP is now at a price point where it will even threaten the viability of sodium-ion batteries if the trend continues. And sodium-ion was all the rage about 2 years ago. So that again comes back to the point that yes, we are enthused about this. Now, when it comes to the materials, lithium and the mineral resources, of course, they're scarce. And there is a question whether the world's entire lithium demand can be met through pure mining or virgin extraction. The answer is obvious. It can't be done entirely by that method. So it's just a matter of time before a recycling industry develops around this. But that is still early days because there are no protocols around how lithium can be entirely recycled. How would you aggregate the scraps, etc. But overall, we are very enthusiastic on lithium, on the lithium value chain and batteries, particularly LFP chemistries.
Okay. And Ravi or Varun, are there investable opportunities within India on that front?
So I think it's a little early days, but there are some the chemical intermediates manufacturer and some battery guys who are thinking of, or rather who are doing some work along those lines. But these are early days. We don't know the winner technology or the player at this moment.
Okay.
So we have, if it is an option value in a company that you're buying, we are fine with it. But we don't want to make that as the sole premise of our investment, battery. Actually, I look at battery and hydrogen as two more triggers for the solar value chain. Because the adoption rates are already very high, but they'll become even more higher.
Get a further kicker.
There will be further acceleration once the entire backbone of hydrogen, to make hydrogen into green hydrogen, it's going to be solar at the back. What is the calculation for one?
So 1 million metric ton of green hydrogen requires 20 gigawatt of solar, and 1 million metric ton of green ammonia requires 5-6 gigawatt of solar. And both these are taking off, green hydrogen and
so
green
hydrogen, and then second is battery. Both the things are further accelerators for the solar value chain itself. One opportunity that probably, which I mentioned when we were mapping out, is the power and transmission. And allow me a couple of minutes to explain why transmission is such a, here and now opportunity. So, it's like if we were in the age of horses, and if we are moving to the age of cars, we need to have the roads paved. If we don't have the roads paved, the cars are not going to sell. Similarly, if we want to move to the age of renewables, we need to have our grid ready. If we don't have our grid ready, the transition is going to fail. The energy transition won't happen. This is the single biggest bottleneck today for the energy transition. Why is this such a big hurdle? Number one, solar plant takes 12 months to put up. If there are delays, maybe 15 or 18 months. A coal plant used to take 4 to 5 years. So now your generation capacity is coming up much faster. While your transmission capex still takes 4 or 5 years. So now you need to have your transmission capex done as of yesterday. That's one. Number two, how many coal plants can power a country like India? 200, 250, 300, that's it. And then you need to connect them to the grid. But how many solar and wind sites you'll have? Thousands. You need to evacuate this power and bring them to the grid. And of course, there is last mile connectivity of rooftop. And then it is a two-way communication. A house can be a producer as well as a consumer of electricity in solar. Then, in terms of variability, what Arvind mentioned, solar generates only during the day. Coal is very stable. 85-90% kind of plant load factor can continue very easily. So from that perspective, also you need a very smart grid, a very efficient grid. Then one more last point is, if you put up a 1 gigawatt coal plant, you will generate 850, 900 megawatt, and you build transmission capacity according to that. But if you put up a solar plant of 1 gigawatt, you're generating only 220 to 250 megawatt of power. But you still need to put transmission capacity according to the peak, which is 1 gigawatt. Because at 2 in the afternoon, it will be full capacity. But you cannot build only for, you have to build capacity for the peak. So that is 5x, right? I mean, almost 5x intensity of power transmission capacity. And last factor is the conversion from
AC to
AC to DC.
AC to DC, yeah.
That requires another 30% increase.
Could you take 30 seconds to explain that?
I'll
yeah.
let Arvind take that.
Yes.
30
so
seconds, please. Yeah.
30 seconds, definitely. One thing that we should remember is that renewable energy assets are no longer located proximitous to population centers. Horses for courses, you put them up where they will generate the most. Usually, instead of now having tens of kilometers to the power plant, they can be as long as hundreds or even thousands of kilometers away. You cannot transmit those distances using AC. AC has certain advantages, particularly a fixed frequency, etc. But when there is a sinusoidal AC in the conductor, skin depth effects will eventually cause heating and transmission losses, which will become unacceptable over the hundreds and thousands of kilometers. So then you have to transmit with DC. And then again, would you transmit high currents? No, you will lose a lot of energy there in heating. So you have to transmit high voltage and DC. So HVDC is inevitable at that point. And then the number of players who can actually play that value chain are very limited around the world.
Okay, and Ravi, so therefore, those are the 5 points that you mentioned, and which brings me to my question that the T&D sector has a here and now opportunity, but well documented, well discovered, or do you think the street is still missing the size of the opportunity?
So you're absolutely right. It is not an unknown opportunity anymore. However, when we are investing in a mega trend, in a giga trend, and when there is a S-curve scale up that happens, you tend to underestimate the kind of growth that can happen. Also, what we have seen in the 2003-8 cycle, I've seen it up close in person, is that the size of the companies changed dramatically. You know, a lot of people focus that these business models are, not sustainable, or this will have a cycle at some point of time. There will be overcapacity, and we are paying too much multiples for it. All of that is true. I don't rule that out. But if you take a 5-7 year view in this particular cycle, this is the space which is going to have the maximum delta. And when I say maximum delta, I'm not talking about delta only in the top line. It's the maximum delta in the bottom line. There is the wait period for HVDC has just gone up from 12 months to 18 months. For entire value chain, actually, the wait period has gone up. We are entering a phase where there is going to be a big clamor. So somebody was just explaining to me, power grid chairman is somebody who's in the power sector, carries a lot of heft.
Of course.
Can you imagine him going to a vendor 5 times in 3 months and telling him, please, I need your equipment? That is the kind of industry situation that we are in. And these are top-down driven objectives. We have to achieve 2030, this X gigawatt. We have to achieve this. Honestly, there is going to be a lot of slippages. I don't rule that out. But give or take 2-3 years, we'll achieve those targets. And if we have to achieve those targets, then this capex needs to happen. I'll give you an example from the 2003-8 cycle. There was a company called Nagarjuna Construction. Not that it managed to retain a lot of the value, but it used to be a 50 crore market cap company, and it rapidly grew to become a 250-300 crore kind of a market cap company, because there was a huge project announced of golden quadrilateral and the east-west north-south corridor, which was a 50,000 crore capex, which was a big number way back in 2002. And what happened in that particular cycle is that company went on to have a 200-300 crore kind of a bottom line. So if your market cap is 200-300 crore and the cycle is still ahead of you, you end up achieving your top line becomes your bottom line in that time horizon. That is the kind of scale up you see. In fact, some of the investments that we have done, that's exactly what is happening. The valuation at which we entered, I end up becoming the bottom line of the company 5 years down the line. Now, that is the simplest form of, the rule of thumb that I have. If the valuation that you are giving, if that company, even if it does cumulatively, not in year 5, even if in a cumulative, if you can generate that kind of profits, then you cannot be wrong about the valuations. So my humble submission is that the cycle is still early. We are still in maybe innings 2 or innings 3. I cannot rule out a correction, a 30% correction any day possible. But at that point of time, it's a buy, and you cannot be thinking about another 50% price drop because the cycle is strong and still ahead of you.
So you do think that some of the companies that are sitting right now, or some of the companies in the right pockets and having the right execution, could well have the size of their profits equal to the valuations or the market caps that are at
Entry
right
point
now.
valuation, not the current valuation.
Not the current valuation, but still, even if they've rallied quite a bit, they would still be materially higher than what they are right now.
Yes,
entirely
for
possible.
sure. Yes. So it's a rapid expansion in the profit pool, and this profit pool is going to be shared by few players. That is why there's kind of premium attached to that valuation.
The only small addition that I want to do is, because people might think that, okay, 2003 to 2008 was a 5-year period, wo ho gaya. Yahan pe they are talking about that. But I've heard you say at the start of the conversation that this is not a 5-year horizon. This is actually a multi-decade theme, right? So it will not stop at 5 years. It will actually last much longer.
Yes, most likely.
So I'll just provide you with a little bit nuance over there. The mega trend will last for 30, 40 years. But your subsectors that will generate wealth might keep changing. For example, I mean, I'm just giving another example outside of energy transition. Manufacturing, or the China plus one, we know as of today, and probably electronic manufacturing is the one that is capturing most of the mindshare for the last 2-3 years. But the trend started with chemicals in 2014. Now, 2014 to 21 was a great period for chemicals. So the rapid profit pool expansion happened at that point of time. Then we had a 3-year period where you did not generate any kind of returns in the chemical stocks. So you will have those periods where you don't, just the physical growth in that sector might not lead to gains for minority shareholders in the public markets. And the trend still remains intact. So you have to still watch out for your entry point, at what point you are entering, and from that point on, does it still look for the next good for the next 3 to 5 years or no?
Got it. So we've discussed solar. We've discussed a bit of T&D. I know that you guys mentioned the nuclear is not the answer necessarily so. Anything else? I mean, hydrogen or something else that is an investable opportunity right now?
Hydrogen is still too early, is
Too
what
early.
we feel.
Okay.
Yes. However, there is going to be substantial opportunity there. If I may for a moment dwell upon this. Conventional energy grids, which are currently in vogue or which are currently running flawlessly around the world, rely on chemical carriers of energy. Humanity has never had a flow-based energy system. And whatever flows, even if there is water, we need reservoirs to store the excess water and control the flow. So as we are moving more towards a flow-based grid, that is one of the reasons why there is also more intermittency and more fluctuations. There is an absolute need for an energy carrier. This energy carrier, in case of fossil fuels, is just a lump of coal. I mean, it can just sit out there as long as I don't get it wet, bunker it properly, it can sit there for several years to be burned and release energy as and where I need it. There is nothing like that of equivalent nature so far in the renewable energy value chain. And while battery storage will cover the short-term energy storage part of it, notice how what one fossil fuel used to do has now again become horses for courses. Short-term kili, where you're going to have batteries, longer term you could convert it to hydrogen, but if you want to transport it for a long distance, hydrogen is not dense enough. So just getting into hydrogen alone doesn't work. You then have to get into the green ammonia and methanol value chains as well. Otherwise it would be like saying, oh, I'll buy a tire and think I've bought a car. It doesn't work that way. So that entire value chain will nucleate over the next 7, 8 years at the very earliest.
But not an investable opportunity right now, because you're looking at the next 5 years of wealth creation, and therefore hydrogen may be a thing of the future.
Exactly, because how lithium batteries will scale will also impact the size of that opportunity. Will it be limited only to the hard-to-abate sector and transportation, or will it take a more central role? This is something which we have to wait and watch.
Okay. So guys, I'm just trying to encapsulate this for the benefit of the listener and the viewer, of course, that this is a multi-decade opportunity. Multiple parts will play out here. But top of the pile, according to you, is solar. That is the kingpin or the linchpin of all of these things, wherein the largest opportunity might be resting. And then there are subsets. I mean, within solar as well, maybe Pix and Chal company or some of the other companies which Ravi already described could be there. There is a bit of an opportunity in T&D, presumably. Maybe the stocks have rallied a bit, but they might come off a little bit and they become good opportunities because it's still an ongoing opportunity. Hydrogen too early, nuclear, the NIMBY effect might prohibit that from being a wealth creation opportunity. Battery storage systems, you guys mentioned, if I'm not wrong, that there is no clear opportunity as yet. Companies are trying to do it, maybe some chemical companies, but as of now, there's no clear answer to that. Okay, anything else that we've missed? It's a very large book, I'm sure I've missed.
A very small part of it that we have missed is biofuels.
Can you please talk about it? I know you are an early investor there, right?
Yeah, so biofuel does not get too much attention, but for India as a country, it is a large enough opportunity. Since we don't, and it might be an interim solution, it's an easy low-hanging fruit. Or if we blend 20% into our petrol, straight away we import that much less of the crude. If we blend 7% in the diesel, that much less. However, there are technological challenges over there. I'm not saying it's happening tomorrow, but that is a low-hanging fruit of opportunity available. And there's something called a circular economy, where basically we generate a lot of wastage in every sector. If we can find a way to recycle and bring that back into circulation, that would become an economy of its own. I think Arvind alluded to it in the case of lithium, but it will happen so across other sectors as well. Then compressed biogas, sustainable aviation fuel. You cannot electrify an aeroplane. I mean, what if you run out of power? There's no way to charge it, right? So you have to, the easy path out there is to blend it with sustainable aviation fuel, which makes it a cleaner fuel. And that is a large opportunity. And if you go through the document that US has just put out, now they are going to, I think 10% blending is it? By 2032.
Yep.
That's the target. And that is a huge opportunity for a lot of companies. I think just wanted to add, even that is part of the energy transition only. It's just that people tend to end up looking at it in a silo as an ethanol opportunity or whatever it is.
Got it. Okay, so my last question will be to Varun. He has some fantastic data points, so I'll ask him on the data points. But before that, Doctor, anything else that we are missing? You have some fabulous insights into this subject. Anything else that we should keep in mind?
Just one thing here. This is also a point of unchecked optimism in certain areas. For example, keeping with Mr. Ravi's point on aviation, let's assume that one flies to Europe. An airplane takes off out of Bombay weighing at about 300 tons. By the time it gets to Europe, it's under 130 tons. You can't do that with batteries. There are certain areas where fossil fuels or dense energy carriers have a role. This is an area which will be catered to by green fuels of one kind or another, or biofuels, which will still have a fantastic runway in our opinion.
Okay.
Yes.
Varun, data point before we wrap up. You come up with some fantastic ones. Give us one more.
No, I think I'll just add to what Ravi was saying about, see, what has happened is our muscle memory in India investing last 20, 25 years is built on where it is the high growth. It was either pharma, again, manufacturing excellence, scale, either consumer. It was not the traditional manufacturing industries which were linked to power or in any way, you know. What has changed now and why these companies are growing at rates which are higher than software companies? And we have evidence from Chinese company, for example, if you see Jinko, J, Longi, 10 years back, they were 1-2 gigawatt. All three of them are 120 odd gigawatt today. So China has more than 8 companies, more than 100 gigawatt of capacity. In India, we have only one company close to 20 gigawatt. Rest of them are at 5-7 gigawatt. We are at the foothills of acceleration, which is led by solar. And now recently you'll find MNRE coming out with tenders of solar and battery combined. So transmission, the first early building block of renewables. If you don't have the roads, how do you evacuate? You have solar, and once you have transmission and solar building blocks solved, then the acceleration is going to be, and I'm going to give you the fact, 2 years back, India was installing 10 gigawatt of solar. 9 months this year, CY24, we've done 17.5 gigawatt already. This year, we're going to do around 23, 24 gigawatt. This is an emerging market where the industry has just begun. And as soon as you have the capability to store excess solar power, store it in a battery, and release it during the non-solar hours off-peak in the evening where the electricity prices are high, it leads to a boom that we can't imagine in terms of whom. So utilities can put up power plants, which are a combination of this, make an IRR, which is a blended tariff of evening and morning. So their capex will increase. You can have FDI, private equity guys come in, because the kind of IRRs that you can make in India, you can't make it anywhere else. And that is going to be, so we are at the beginning of this trend. A 25 gigawatt annually, Ravi already mentioned, India is going to become 60 to 80 gigawatt annually within the next 7, 8, 10 years, okay? And let me give you the final stat. In 2000, we installed 1 gigawatt in a year globally, okay? In 2000. Around 2006, we were doing 1 gigawatt in a week.
Sure.
This year, CY24, we are doing close to 480 to 500 gigawatt. So that's 1.5 gigawatt per day. That's the kind of load that is coming on transmission. That's the kind of industry opportunity that there is. And India is only just going to follow that trend. It's going to lead the trend, in fact, apart from China.
Cross fingers.
I'll just give you statistics. The overall encompassing energy transition as an opportunity measured by various agencies like International Energy Agency or Fidelity, McKinsey. Everybody has tried to gauge what kind of an opportunities. As of today, we are spending around $1 trillion on everything related to energy transition. This number, even if I take an average of everybody, will be somewhere 3x to 5x in on an annual basis. So $1 trillion per year spend is going to go to $3 to $5 trillion a year spend. And this is if we spend regularly and sequentially till 2050. That is the kind of jump in spend. However, things don't happen that way. It will happen where there will be a sudden spurt, there will be a non-linear growth. So 1 trillion will probably go to $8-10 trillion in the next 7, 8, 10 years, and then peter out to a 3, 4, 5 trillion kind of a spend. So you will see probably exponential growth that we cannot imagine in entire energy transition value chain.
I'm hoping that we do something like this every year to measure how this goes, but because this was fascinating. And in some sense, it's not a very exciting here and now subject, but it was lovely from you guys to come in and explain the way you did. It was a lot of learning for me, and I'm sure a lot of learning for our listeners and viewers. To all of you, thank you so much, Team ValueQuest, for coming in today.
Thank you so much. We enjoyed it a lot.
Thank you very much.
Thank you. And viewers and listeners, thank you so much for tuning in to yet another Talking Point podcast.